Hello and welcome to my new channel, Accounting with Sandra. My name is Sandra and I'm an accountant and lecturer, and I'm hoping to help students and those with a keen interest in accounting and taxation to understand accounting and taxation concepts with videos in 5 minutes and under. In this video, I'm hoping to explain and clarify the concept of a liability. Over the next couple of videos, we will discuss the other remaining types of account balances, which are equity, revenue, and expenses. Assets were discussed in my previous video before bringing them together to discuss the four main types of financial statements. So let's begin. What is a liability? So once again, while there is no specific accounting standard which defines what is a liability, we can refer to the Statement of Accounting Concepts number 4. SAC 4 defines a liability as the future sacrifices of economic benefits that the entity is presently obliged to make to other entities as a result of past transactions or other past events. So let's dissect this definition. Firstly, there is a requirement for a future sacrifice of economic benefits to exist. That is, there must be an adverse financial consequence for the entity in that the entity is obliged to sacrifice economic benefits to one or more entities. Usually, these economic benefits will be in the form of cash. So that is, if you enter into a contract to build a new warehouse, you will be required to pay for the construction of the warehouse, which is the sacrifice of future economic benefits. Secondly, a present obligation for the sacrifice of these economic benefits must exist. This present obligation results in a duty or a responsibility to act or perform in a certain way. Where such an obligation arises, it implies that there will be at least two separate parties to the arrangement, namely the entity in question and a third party external to the entity. The entity in question cannot be both the recipient of the good or service within the transaction and also obliged to pay for this particular good or service. So for example, if you are an entity involved in the sale of inventory, you cannot buy inventory from yourself. Additionally, it's not necessary for the identity of the third party to be known for a present obligation to arise. Most obligations are legally enforceable in that they stem from legally binding contracts or the provision of an invoice. And lastly, a past transaction must have occurred which has given rise to the existence of the present legal obligation. If you sign a contract or you enter into an agreement to purchase inventory, these transactions result in the recognition of a present legal obligation. A couple of considerations to bear in mind. As with assets, it is necessary to consider the timing of when the future sacrifice of economic benefits are required to be made. Where these sacrifices are due within the next 12 months, the liabilities will be classified as a current liability. Conversely, where they will be payable beyond the next 12 months, they will be classified as a non-current liability. So for example, if you have a bank loan with a term of 5 years, the principal and interest obligations due within the next 12 months will be considered a current liability, and the remaining 4 years will be considered a non-current liability. As such, each year the accountant will be required to adjust the loan account balances to ensure that the current and non-current portions are correctly disclosed. Additionally, for a liability to be recognised within an entity's accounts, it must be both probable that the future sacrifice of economic benefits will be required and that the amount of the liability can be measured reliably. The term probable in this case means that the chance of the future economic sacrifices being required is more likely rather than less likely. Lastly, it is vital to distinguish between a present obligation and a future commitment. The mere intention to sacrifice economic benefits in the future is not sufficient to give rise to a liability. Where it is not probable that any future economic benefits will be sacrificed from the arrangement, then the amount which may be paid in the future is not recognized as a liability and may instead be recognized as a commitment. Commitments are considered within the accounting standard AASB 137 and will be discussed in more detail in a separate video. For this video's purposes, a commitment is deemed to arise where there is either no present obligation to make a payment for a past transaction or event, or a payment obligation is subject to the satisfaction of a future condition. A commitment becomes a liability once a present obligation arises for payment. In other words, if you enter into an agreement which requires a certain amount to be paid each year, subject to the satisfaction of a particular condition, so for example, a certain period of time is required to be satisfied, or a sales condition needs to be met, This obligation does not satisfy the present obligation condition for the amount to be disclosed as a liability. In these circumstances, no present obligation will arise until these conditions have been met, and as such, these future obligations will be considered to be a commitment. Once the required condition has been satisfied and the present obligation then arises, the amount will then be recognized as a liability. This distinction is significant because where an amount is recognized as a liability, it will need to be disclosed on the face of the balance sheet. Where an amount is a commitment, it is not disclosed on the balance sheet, but is instead disclosed by way of a note to the financial statements. I hope this video has helped to clarify the concept of a liability. The next video will consider what are equity accounts. Thank you so much for your time.